Is steady income the same as true wealth? Most people answer yes, but the data says otherwise. In this short documentary, we'll expose the difference between income and wealth, why it matters, and 3 actions that actually build wealth. First, a quick definition. Income is cash flow, wages, salaries, interest, dividends, and rental receipts you receive over time. Wealth is stock, the accumulation of assets and net worth that generate future income and provide financial security. Think of income as the river and wealth as the reservoir that stores water for droughts. Here's a hard fact. Median household income in many developed economies rose modestly over decades, yet median household net worth often stagnated or became more concentrated. That divergence is the core issue. Why does this happen? 3 forces drive the gap. Number 1. Consumption patterns. When income rises and spending scales with lifestyle, saving rates stagnate. Many households increase expenses when paychecks grow, leaving little to convert income into assets. Number 2. Asset ownership concentration. Higher income groups gain disproportionate access to appreciating assets like stocks, real estate, and private equity. These assets compound returns and expand wealth independent of salary. Number 3. Leverage and financial engineering. Borrowing strategically amplifies returns for investors who use debt to acquire income-producing assets, while wage earners often borrow for depreciating liabilities. Let's quantify these ideas. Compound returns matter. A 7% annual return doubles your investment roughly every 10 years. If someone earns $40,000 and saves 5%, that path leads nowhere near someone earning the same but investing aggressively in appreciating assets. Ownership rates tell the story. In many countries, the top 20% hold over 70% of equities and private investments. That means gains from market growth disproportionately flow to those already wealthy. Another metric, net worth volatility, shows resilience. Wealth cushions shocks like job loss, medical bills, or market downturns. Income without savings leaves households exposed. So what shifts income into wealth? Action 1. Prioritize asset accumulation over consumption. Contribute to equity index funds, rental properties with positive cash flow, and retirement accounts that compound tax advantage returns. Action 2. Focus on ownership and diversification. Seek fractional ownership if direct purchase is out of reach. Use funds, REITs, and ETFs to get exposure to appreciating asset classes. Action 3. Use leverage wisely and protect downside. Low-cost leverage, such as mortgage debt on rental properties with strong cash flow, can amplify returns, but always stress test scenarios and maintain liquidity. Behavioral rules help. Automate savings at source, apply a reasonable budget cap on lifestyle inflation, and adopt a multi-year investment horizon. Real examples underscore the point. Consider 2 professionals with identical incomes over 20 years. One spends raises and saves little. The other saves aggressively and invests in diversified assets. At year 20, the investor's net worth can be multiple times higher, driven by compound returns and asset appreciation, not higher salary. Policy and systemic factors matter too. Tax incentives, access to credit, and financial education affect the speed at which income converts into wealth. For many, institutional barriers limit asset access, which explains growing inequality. But individuals can act within constraints. Start with small, consistent steps. Increase savings rate by 1 to 3% each year, allocate incremental savings to low-cost diversified funds, and reinvest dividends. Monitor net worth, not just income. Track assets, liabilities, and progress toward targets. Wealth trajectory is a function of savings rate, return on invested capital, time, and leverage. Use a simple formula. Net worth growth tetherly savings rate times return times time, adjusted for leverage and taxes. Finally, adjust mindset. Value ownership and long-term thinking. Income funds lifestyle, wealth funds freedom. If you want stability, focus on converting a portion of every paycheck into appreciating assets. To recap, income is flow, wealth is stock. Spending more with higher income rarely builds wealth. Prioritize saving and investing, diversify ownership, and use leverage prudently. Measure progress by net worth, automate contributions, and guard against lifestyle creep. The difference between income and wealth defined, quantified, and turned into action can change your financial trajectory. Apply these 3 actions consistently, and in 10 years, you'll see compounding work for you. Remember, it's not how much you make today, it's how the money you keep and invest grows tomorrow. Follow for clear finance breakdowns and start building real wealth today.